Hey investors and YouTubers, it's Ernie from Shark Investment Research. Well, we all know that the drug industry was pretty volatile even before COVID-19 came on us. Well, nothing's changed, it's still pretty volatile. But yes, there is one standout that makes our list as a qualified investor. Well, I'll tell you what, let's take a little twist here though. Let's compare that company with another company who's heads on in the race to find a vaccine. And let's see how they play out for us. Come on, let's go swimming with the sharks and see who we're going to put our money on. If you're new to us or you just need a quick reminder, remember it is very hard to get on our qualified list. A company has to meet one of these 6 criteria. They either have to have 17 years of increasing cash flow, earnings, or dividends per share, or with cash flow and earnings, they can be allowed 1 flat or negative year, and with dividends, 1 flat year. Those are 6 hard things to do, and they got to achieve at least one of them. Now, this is all based on data that comes from the Value Line Investment Survey, www.valueline.com. If you want to take a look at more of their products, I encourage you to do so. I am not an affiliate. I am a subscriber. I am not being compensated in any way by Value Line for this production. The first of the 2 companies we're going to look at is Pfizer. Pfizer is one of the lead companies in the race to find a vaccine for COVID-19. But as you can see, Pfizer does not meet our criteria as a qualified investment. Look at that. They're not qualified for cash flow, they're not qualified for earnings, and they're not qualified by dividends. Now, they do have a nice dividend at 4.2%, but as you can see, they dropped it back in 09 and 10. And that's on a valid price of $36.02. Well, let's see what they look like from a long-term perspective. So here is their 17-year history, and it's got this weird bow shape to it. But you can see all the volatility that you expect from a drug company, especially one that is into research-based biopharmaceuticals. Now you can see that their dividend from 2010 on has been a pretty straight line. I mean, that's a straight line, right? So I think they're trying to figure out how to take care of their investors while they're still moving forward as a research type biopharmaceutical company. The year-to-year changes clearly show the ups and downs of this company throughout its history. So here's Perrigo. Ticker PRGO. They're paying 2.1% on $45.92. They're not qualified for cash flow or earnings, but they are a Div 0, so 17 years of increasing dividends per share. Now, Perrigo is a very different company than Pfizer. Perrigo makes over-the-counter store brand drugs and other products. It also has infant formulas and animal health care products. So it's not that it doesn't have those huge R&D kind of costs that Pfizer has to foot the bill for. Now, the long-term trends for Perrigo are kind of interesting because you can see cash flow and earnings. They were going through the roof till 2015. And then they made some changes to their strategic plan, and well, it's not been going so good, although they think they're turning things around. Analysts think they're turning this around, so there may be a long-term good story here. But they've tried to keep their dividends, even though they're low, they've tried to keep those on an upward trend for investors, and that's why they're qualified, because they're a Div 0. Every year, they've increased those dividends. You can see that in these year-to-year changes. Well, let's go ahead and lay them side by side because this is a comparison after all. So here you see in the green Perrigo, and in the blue, Pfizer. So from cash flow perspective, you've got Perrigo bringing in more cash per share than Pfizer consistently, even after they did their big change and strategic shift. They're still outperforming Pfizer. So it naturally flows that their earnings are going to be better than Pfizer's. Now here's where we got to do some interesting talking, right? Because Perrigo is clearly underperforming Pfizer from a dividend perspective. Dividend per share, the Pfizer folks, Pfizer investors are much better off. And if they could have stomached this downturn, then, well, they took them a while to get back up to where they were being rewarded, but they're back up there now. And there appears to be a good long run to keep it going. By our qualification standards, Perrigo is the company that you would invest in because they're the only one of the two that meets our qualification as a Div 0. But when you look at this chart and you see how Pfizer has turned things around and put investors back on track again, I'm thinking Pfizer is the way to go. Plus, if Pfizer does come through with a vaccine for COVID-19, they're going to be in a very good position moving forward. Now remember, all this data comes from the Value Line Investment Survey. This is issue 8, dated 2 October 2020. You can get more information from www.valueline.com. But the important thing to note here is in the drug industry, they have 29 companies listed. So I looked at 29 drug companies. Only Perrigo meets my criteria for 17 years of increasing, in this case, dividends per share. Pfizer did not meet the criteria, but they look like they're the better investment. So doesn't always mean that just because somebody's on my list as a qualified company that there isn't a better investment out there if you have a little more stomach for the volatility of the other company. Well, I'd like to know your thoughts on the drug industry in your comments down below. If you enjoyed the video, go ahead and give it a thumbs up. Don't forget to subscribe to the channel, that red button in the lower right-hand corner. And here's links to some more of my quality analysis to help you with your investment research.